I'm Hunter Thompson, and welcome to the Cash Flow Connections Real Estate Podcast. How's it going, everyone? Welcome to the show. Welcome back to another episode. Today, we've got Marshall Sykes here. You can learn more about him at investwiththecaptain.com. He grew up in a real estate family, is a retired Navy captain, has been involved in more than 20 syndications. He's also a member of Capital Collective. And it's been awesome to see you grow, working on that personal brand stuff, which I always like to see. Marshall, welcome to the program.
Thanks, Hunter. Thanks for having me. It's a pleasure to be here.
So, over the last couple of years, we got to know each other, and I think you have a really interesting story, especially just given your background and you've transitioned and been involved in not only a lot of different deals, but also a lot of different asset classes. I'd love to learn more just about your story, and then we can talk about kind of the way you're playing the game right now and your vision into 2025.
Yeah, I think it all starts really when I was growing up in my teenage years, working with my mom and dad building houses. We would build two at a time. I hated the work personally because it was a hot summertime in North Carolina, but I learned a lot. I learned about hard work and about doing your best every day, but I also learned about real estate investing. And they would build two houses at a time, sell one to live off of, and keep one as a rental. So I saw that pattern. I kind of put it in the back of my mind. Went off to college, got my engineering degree. Then I went in the Navy as a civil engineer corps officer. Where I was involved, I was a construction manager, essentially building facilities on military bases. And along those lines, my wife and I were moving around quite a bit. She was a chemist and she would have to get a new job all the time. And we finally said, "Hey, let's save up all your income on this job." We didn't have kids yet, and let's invest in real estate. And then we can have kids as well, so you can stay home with the kids like she wanted to do, and she loves doing. But also she can manage the real estate portfolio. So we started doing that and got involved in on the single family real estate side of the business. And then fast forward 30 years after having that portfolio for so long, we ended up learning about syndications, and then I got involved in the syndication business.
Got it. So were you typically just buying single family houses just yourself? And that was kind of like the number one strategy. You weren't really raising money, you're just buying them to buy and hold.
Yeah, so we were buying it. We were actually I was leveraging my family resources. So
Okay.
I always encourage people to leverage their any kind of resource they have available. And in my case, my brother wanted to build for us. He
Okay.
would take a builder's fee, keep his crews busy, but also give me an advantage of buying a house, a brand new house. And we did that pattern for, I don't know, 8 or 10 houses. We ended up with a small portfolio of houses. So anyway, that's kind of what we did, and but we weren't raising money. We were just buying the houses ourselves and managing the properties.
When did you learn about syndications? Do you remember what was like the first deals you started seeing and what the numbers look like?
Yeah, so this is I first started investing in real estate and back in the late '90s, and you know, I was in the oil and gas business at the time when first heard about syndications. We had just moved back from Dubai. We lived in Dubai. I was working in Iraq in the oil fields there. And I came back, I heard somebody talking about it at work, and I heard a little bit on the podcast, and thought, wow, can you really do this? Can you do
Mm.
syndications? I had never heard of such a thing. So this is in 2018, 2019. And so I learned about them that way. And what I did was I tested the market at that point. I, I, I invested in three different multifamily assets with three different operators in three different markets.
Okay.
So I wanted to learn all about how the operators did things differently and how the markets were differently. And so that was my test case and a test basis before I started actually co-GP and or being a general partner on deals. I was a limited partner at that point.
Got it. So your background, oil and gas, did you not see deals getting put together like this, or was this more like they were doing like institutional deals? You know what I mean? Like from a structural standpoint, how are those deals getting done in the oil and gas business?
Yeah, no, I was with ExxonMobil, so it was just we were doing, multi-billion dollar projects with several different big billion dollar company partners. So I wasn't involved in that part of the business. I was more involved in the contracting strategies, the project management, and the construction of a facility.
Makes sense. Okay, so you find out about this world of syndications, you start doing some passive investments. How do those go? And then how do you start to think, okay, I could make a business out of this? And just tell me about that whole transition.
Yeah, I mean, obviously, and I mean, syndications just really appealed to me because it was an easy way for me to be able to explain to others that they can get involved in real estate because people like real estate, but they had a hurdle of getting involved or understanding or having the time to do it. And so I felt like that was an opportunity for me to be a partner since I already knew a lot about it and help others to be able to invest in this type of asset. And so that's what drew me to it. And so I learned a lot. I joined a coaching group. I because I wanted to partner the right way. I didn't want to just go out on my own. I wanted to have build a team. And so that's kind of how I got involved early on in syndications.
Got it. Okay. And so since then, I know you've been involved in a lot of different structures and asset classes and, businesses. What was, when did you kind of understand that if you can do this with multifamily, you can do this with anything? This kind of changes the whole landscape in terms of investing. Did you have that view? Did you have that transitional moment? And like, walk me through that.
Yeah, I think that happened about 2 years ago. I was at the actual Raise Fest in Louisville, and one of the speakers actually said, "Hey, if you really want to raise capital, I mean, to appeal to your investor community, you want to diversify a little bit." And that
Hmm.
really struck a chord with me because I was like, "Well, I know the oil and gas business. Why can't I raise for oil and gas? I know other types of real estate. Why can't I do that?" So that was kind of the aha moment for me to go ahead and explore other opportunities and invest in something else.
Okay. What were the things? Obviously, you mentioned oil and gas. That's kind of like a crazy business. From the outside looking in, I've looked at some oil and gas deals. It's from my perspective, and maybe this is just my limited experience, but it's kind of like there's a lot of secrecy. There's a lot of, it's difficult sometimes to create comps and such. Like you can't just pull it in the same way, like barrels per day and stuff like that. My understanding is it's not as readily available as, let's say, something like this apartment unit's renting for this, then one next door is renting for this. Did you end up doing any of those oil and gas deals? Would love to learn more about that.
Yeah, so I ended up finding a really good, strong sponsorship team. So when I decided I want to do oil and gas, I looked for a strong partnership team that had done it for a long time, and I found that opportunity early last year,
Okay.
and I what I did was worked with them on understanding a few things that maybe I didn't understand because I knew oil and gas, but maybe I didn't understand how the deals were put together sometimes.
Yeah.
So these were in the United States. So this is I only do the oil and gas deals in the United States with strong operators who've done business for over 20 years.
Okay.
So they knew what they were doing, and they weren't the operators of the actual wells. They knew how to do that. They've done it in the past, but we were working with billion-dollar companies. They weren't the ExxonMobil and BP and Shell, but they were the next level down. And so like Devon Energy, a Continental. So they knew what doing. They're billion-dollar companies. They and not only that, they were already producing. We bought into a lease where they were already producing the oil, so the infrastructure was in place, the oil was pumping, the cash flow was day one, right? So you're not drilling. The other way to do that is to wildcat, if you want to call it that. They go out and explore and try to and
Hmm.
drill a well in an unproven place where they think there's oil, but maybe there's not. And so if you do that and you have a dry well, then you lose all your money. So I wanted to avoid that. The first thing I wanted to do was keep investors' money, right? And my money too, because I was investing alongside this. And so I like that concept of where the oil was already producing and the wells were already in place.
Got it. Yeah, and I'm sure you kind of heard this as well, like in the world of oil and gas. And I'm not poo-pooing it at all. I'm sure you've probably seen this. You know more about it than I do. But there's like this thing where it's like, hey, you got the operator, you got the promoter, we call it promoter in oil and gas, which is like the capital raiser, and the investor. And he's like, only two people are making money in this transaction, and it's not the investor. And I've heard that. And it's because a lot of the wildcat stuff. It's like, yeah, we're digging, but we just don't find anything. I'm sure you've probably talk to investors about that fact that that's different than that business model. Would love to learn more about how you kind of planted your flag in the ground to say, hey, listen, if we're buying proven wells that are actually already performing, this is like a categorical shift than like going out into unproven land.
Yeah, exactly. Because, and not only that, we bought into like 50 different leases. So it was more
Okay.
than one lease, and each lease had about 50 wells. So you have a lot of wells. And in the oil and gas business, you're when you drill a well and you start producing, there's a depletion rate. Every year there's, a certain percentage of depletion that's going down. So the well is going to at some point run dry, maybe 20 years down the line. But at some point, you got to drill new wells. So you have to have a lot of wells to make it more risk, to mitigate your risk. And that's one thing I liked about it as well, because there were so many different leases that we were buying into and multiple wells in multiple different locations.
The other thing, though, is because the wells will eventually run dry, the returns are such, and just the nature of what you're investing in, you have a bigger cash flow in years one, two, three, four, five, like really significant cash flow to make up for the fact that over a 20-year period, they kind of go to zero, essentially. So it can really offset your portfolio if you're only invested in, let's say, really prime market multifamily, where in today's climate, you may get 5% cash flow, 4% cash flow. You invest in an oil and gas deal. What would be like back then? What would be like a typical cash flow in year one, two, three, four, five?
Well, the deal that we're in, that we're doing right now,
Mm-hmm.
and where the wells were already producing and may have been producing for a few years, we're getting a 15% return on investment in the year
Wow.
one. In
Wow.
year one, which is really good, really
Yeah,
good.
for sure. Okay, cool. And then what are some of the other things that you've looked like? What are you kind of looking at right now? Obviously, 2025, things are changing. We've heard this mantra of survive until 2025. It's about to be 2025, or it is 2025, depending on when you're listening to this episode. What are you kind of most excited about in the landscape? What do you see as changing, and where's the opportunity going to be?
I think there's a lot of people looking into syndications, so I think that especially I think some of the things that I like as investors like is new tech deals if they're with a proven operator or
Okay.
proven entrepreneur who's done it before. I like that. But also, I mean, right now, I know multifamilies had a big hit over the last couple of years, but I think right now, if you buy a deal right now and you're buying at the bottom of the market pretty much, and that's a good opportunity to buy at the bottom of the market. So I think that's a good investment over the next few years as well.
I agree.
Um,
You and I were talking offline about kind of the headaches of being a capital raiser. And I was being honest with you about the fact that depending on the timing, you can go 10 years without hearing about money being lost in a deal. You can go 10 years without there being a capital call. And then they all happen at the same time. And people go, why am I in this industry? It's like, well, you forgot the decade before was really, really smooth sailing. And it's a very lucrative industry as well. So it's just that's why the cycles play with your minds. But I'd like to go back to the topic about tech. Tell me more about this because obviously that's a very broad kind of thing. When you think about someone with a track record and stuff, what would be, and you don't have to give specifics, but like, what do you look for when you go into, if you were to see an email or get an introduction, what would be the kind of thing you'd look for in a deal to make it compelling to you?
I think, I think the sponsor always makes a difference, right? So you do want somebody who's done it before. They've proven that they know what to do with the technology startup because a lot of technology startups are people who are very smart. And I'm an engineer, there might be an engineer or some kind of designer, but yet they don't understand the business. They don't understand
Yeah.
how to get something to market, and it may not ever happen. Even though their idea might be good, getting it to market is a different story. So
Hmm.
you want someone who's done that before. They not only smart on the design, but they know how to get it to market, and that's one thing I look for. The other thing I look for is when you're doing a technology deal like that, it's really all or nothing. So you want a big payout if it is going to be something, right? Because
Mm-hmm.
there's a big risk on losing your money as well. So you gotta weigh that, and you gotta be upfront with the investors on that. That's part of technology startups is the market has got to embrace the deal, and the operator's got to get it to market before that even.
Interesting. Okay, we'll talk more about the return profile, how you kind of manage expectations. What are some of the within technology, what are some of the tailwinds or headwinds that you're seeing? Like what niches, what like is it SaaS? Is it something else? What's your perspective on that?
Well, I mean, probably, I think anything that can be done with AI, I think is the big thing right now. So
Okay.
if there has to be an AI component, it seems to me, in any of these deals, because that really accelerates things on the market side, because the market's all about AI and embracing AI right now. So that helps to sell the deal to the market, but also to investors to see the potential in that. So I like that. Um, I do I do think that I've seen some platforms where they do small investments. So you do more like a crowdfunding sort opportunity there.
Hmm.
So that's another thing to look at. But also something that takes simple like a Wi-Fi opportunity and takes it to like 10x is the Wi-Fi capability. Something like that is appealing, and it can really make a big impact in the market embracing some type of technology like that.
That's an interesting one. I'll say the AI functionality stuff is, it's rare that a technology comes on along that really moves the needle. And I'll say it's rare. It happens, like we call it every 5 years, every 10 years, where something really significant comes along where it's so early, it's so significant that for a moment, the market doesn't even know what it really is. They just knows that it's something that's cool. And the challenging thing about investing in technology is that sometimes there's something that looks cool, but ends up not being very useful, but it has a ton of momentum because it is new. And then something else that has a ton of utility, but it's unclear how it's going to uncover itself. So it's going to be interesting in the future how like AI and the integration with AI. I mean, as a marketer, obviously I use AI all the time, but it's like for coming up with things like, hey, how do I write an email that says this, or come up with 10 ideas about videos that say this point. But there's much more programmatic and practical uses as well that other people in other industries are using. So it'll be interesting. What would be the kind of thing that you're going to look at in 2025 as a potential red flag? Is there anything that when you go and look on the internet, when you're looking at Twitter, when you're looking at whether it's the stock market or recession indicators, is there anything that you've got your eye on the pulse just to see if things change and maybe your tune will change as well?
I don't know that any major red flags. I think really I look at kind of the sponsors more than anything, and whether they make too big a boast on returns and the marketability on things.
Yeah,
So that's kind of what you have to. That's the main red flags I look for.
it's
I don't.
interesting that you say that. It's funny that you say that because I spend a lot of time focusing on the economics. Obviously, I'm an owner operator, so it's a little different, but I think you're so right. A good operator can do very well in challenging times. And even if a deal is challenged, a good operator will do the best it can possibly do and the best that they can do. A bad operator cannot do well even in good economic times. I mean, that's the reality of the situation. Even if the deal goes well, the investor experience will not be good. The reporting will not be good. The decisions will not be good. And so you can get bailed out by good economic experience, but most of the time, savvy past investors know how to pinpoint that, and you can't get them to reinvest again. So I like that focus on the operator. It makes me want to ask, what are you looking for in an operator?
Well, I think for me, I've been in a lot of deals, and some of them haven't gone as well as we would hope, and some have gone up better than hoped. But so one thing that really stands out to me is having a a strong leadership team that that works together and they're aligned, but also they have depth of experience and depth of bench depth, I guess. They have a big team. They don't have to have a huge team because you can't make money that way necessarily, but you've got to be able to control the costs from let's use unit multifamily for example. Control from the when the money comes in at the rent all the way through the property management system into the asset management side to be able to make that profit. If the property manager is not aligned with the asset with the owners, then that causes a conflict, and a lot of times the money is spent somewhere that maybe that shouldn't be, and
Hmm.
the profit's a little bit too low. So that's one of the big things is I look for how strong the operating team is, and can they, because they have to have strength to overcome those challenges, and they will be challenged in any kind of business through the market, right?
Yeah. One thing I say as a way of kind of paraphrasing that is like how much of this business plan that you're talking about is rinse and repeat versus like a new initiative that you've never done before. And that is inclusive of team members, strategy, technology, market, labor, vendors, property managers. You can go on and on. But if it's your 20th deal that looks a lot like this and this is your 21st, I feel way more comfortable if there's a significant change between your 20th and your 22nd. And by the way, this actually happens all the time because as operators grow, they are people too. And they start to get shiny object syndrome a lot as well, meaning that if they've built their career in the hotel industry and now the hotel industry is overplayed or over competitive, they make a pivot in their business. You don't want to unknowingly be the first dollar in on some new initiative in, multifamily development, for example. So just something to think about. What else would you say? Obviously, the sponsorship team, when you go one level deeper, let's assume the team, you like them, they've got a good track record, you also have a good gut feel from them. What are the other things that you look at when you go a little deeper in due diligence?
Well, I think what you brought up just now, it really sparked something in my mind because when I was at Exxon, we would put extra contingency in a project that was a retrofit or a new market or with a new partner that we were doing business with. So you got to put extra money or you have to have some kind of, there's more risk in that is basically
Yeah,
what you're getting at. All those
exactly.
factors that you mentioned, they're all about risk, right? If an operator has been in Dallas for the last 10 years and they decided to go to Houston for the next deal and they don't really have a presence there, that's a risk. And so
Yeah.
you got to think about that as an investor. Do I want to be involved in that? And how are they going to mitigate that risk? I mean, it could be a good deal, but they've got to prove that they're mitigating that risk.
You've got to calculate it as the investment that you're making that is a risk because what ends up happening is that if you look at an Excel model, and many of us like to do this because the reason we like commercial real estate is it really is about the numbers and you can look in Excel and it'll paint a compelling picture versus residential when it's like how much is the property worth? I don't know. The guy's wife really likes it. Like it's a kind of it you can't put it in Excel, right? But in this industry, you can only really take the Excel model seriously if you understand the likelihood of the business plan being executed. Meaning that if this is the 20th deal that looks exactly like this, and this is the 21st, you can take the Excel underwriting model way more seriously than if they have never done it before. And as a person who owns a business, I know that the nuances matter tremendously. So even something as simple as we're getting a new property management software, that alone is a risk. Now, most investors aren't going to that level of detail, but like I know as a business owner, there's a risk that we may not like it because it doesn't really work. Or, how new is the property management software company? Are they venture backed? Is this their last dollar? Like you and I both know that those implementations of those new technologies or new relationships matter tremendously. I'll give you another caveat with this or another kind of thing to think about if you're a passive investor. When it comes to the loan, I hear very few people ask who the lender is. And this is a similar discussion. Is this a lender that you've worked with before? Is this a lender that's competent in the asset class? If you're doing well, are they going to know that you're doing well and be flexible if something goes wrong? Or is it the first time they've ever lent on the fill in the blank, self-storage asset class, senior living asset class? These are nuanced asset classes that some lenders just don't have a really big background in. So the more you can reduce this business plan implementation risk, the more objectively you can make a decision whether or not to invest.
Right. I mean, I think a few years ago, you might assume that most lenders were similar. But
Yeah,
the last couple of years, with the interest rate going high so quick, that put a lot of risk in the lenders lending space. And so
absolutely.
I saw over my different syndications, I saw so many different lenders act differently.
Yeah.
And some of them want you to sell a property when it's not time to sell because of that lending risk.
I'm not going to mention any names, but we've dealt with a lender that I wouldn't have, it shifted my scale of what that relationship could be like. Where, you come to a meeting and you're like, okay, here's the situation, here's what we think is reasonable. And then it's like what they present is not at all what we anticipated. And it's just that's their business. That's their core value. Like it has nothing to do with trying to find out the right way to handle certain things or the path of least resistance. It's no punitive. That's the energy. And we don't care if you go and do a podcast about us. We're going to do that because that's the way we're going to carry ourselves. It's pretty wild. So I would definitely start thinking more about that if you're an investor and a significant passive investor in particular. The lending risk is a huge risk, and knowing who you're dealing with is important as well. Okay, let me get. I know we talked about kind of different asset classes. What about different geographic locations in the United States? What are some of the things you're like most bullish on, and then some of the things maybe you think are due for a pullback or you're not so excited about?
Well, I mean, I think, at this time of year, usually you have a lot of different people talk about what the 2025 market is going to look like or the next year's markets are going to look like and which ones they think are strong or not. I do think I've heard that the Midwest is a good opportunity there because it hasn't seen a major growth in the last few years. And so it's been a steady growth. And
Hmm.
so that's a better opportunity it's a lower risk opportunity, if you will. I mean, Texas and Florida were always very hot the last few years, but they've also been overbuilt. So
Yep.
that's a risk as well because you can't raise the rents as much, or the market rents start going down because you overbuilt, right? Um, I mean, that happened in one of our properties in Jacksonville, Florida. We had a nice Class B property in a really nice area, but somebody built a Class A property nearby and they had all kinds of specials and we had to lower our rates just
Hmm.
to compete with a Class A facility like that.
And that can
Um,
happen. Developers are attracted to those quality markets. And so, in some ways, it's a good sign that your economics are such that developers are attracted to your market. The problem, though, is it comes down to the loan. Because look, if you've got a 5-year loan and someone develops a property right next to you, you're probably going to make it okay. That's the reality. Yes, there will be some softening, but it won't be material. The challenge, though, is when you come up for a refinance in the middle of them leasing up and giving away 2 months free. So just be careful about the lending piece of this whole thing. Okay, cool. You talked about the Midwest as well. What other topics do passive investors need to be focused on as they kind of think about their portfolio and build something that they're excited about?
Well, I think when you look at investing, you're looking at the big three, I think, are tax benefits, appreciation, and cash flow. So which one of those is more important to you? I think that's the kind of investments that you need to be drawn towards. But you want to diversify your investments too. So you want to have a little bit of multifamily, a little bit of oil and gas, maybe some new development, or even I raised for like a lending fund. So it's basically you're being the bank.
Hmm.
So it's a lot lower risk. You've got a lot of collateral behind it. So and you may not make as much money on it, but it's still over, 12% or so per year. It's not bad. So it's a good opportunity instead of leaving your money cash in the bank, for example. So I think a little bit of diversification and just being able to figure out which of those big three are the most important to you. Like one of my investors, he doesn't want cash flow. He already makes enough money on his W-2. He doesn't
Hmm.
want cash flow. He wants appreciation later on when he retires, so he can have the appreciation later, but he also wants tax benefits now.
Okay.
So those are you have to kind of make as an investor, you got to be able to understand that which one you're going for.
And I know you're working on a new ebook that should be available by the time this is launched. So tell us just a little bit about that, and we can link to that in the show notes page.
Yeah, appreciate it. I've created one that kind of goes after an ebook that tells investors why it's important to be in an alternative investments, not just in the stock market, because the stock market is not really, they say it's diversifying, but it's really not. You're in one market. And if the whole stock market crashes, you're down altogether. But so you want to be able to diversify into alternative investments like multifamily, oil and gas, build to rent, that kind of thing, or self-storage. But that my ebook will explain a little bit about that. Tell you, give you an overview of each one of those asset classes, the big four that I'm involved in, but also will give you some hints on tax depreciation, tax benefits, and which ones are better for appreciation and cash flow.
Love that. And so again, you can get access to that for free at investwiththecaptain.com, which will link to the show notes page. Marshall, thanks again, man. Always a pleasure.
Hunter, it was great being here with you. Thanks for having me today.
Talk to you soon.